Hey guys, John here with 3talentstrading.com. John Allen, I'm your host here, and I didn't post a video last week because I was a little under the weather, but I'm back feeling pretty good, so I want to get back in the groove here with you guys and move forward and get an update as far as what's going on with the markets and so forth. Before I forget, if you like what you hear, like on this channel, please like and subscribe. We are going to launch our official Telegram channel the first week of January. So if you want more information, you can email us at 3talentstrading@gmail.com. You can visit our website, 3talentstrading.com. And basically what we try to do here is just follow trend, whether we're trending. The markets do three things: they either trend up, trend down, or trend sideways. Heard that from a very smart mutual fund manager when I went to a seminar in Chicago, and he is definitely right. So if you can pretty much master the trends, you can make money in the markets. It's difficult to make money in a sideways market, but you can make you can make good money in an up and a down market. So that's what we try to do, is we try to follow trend, and we basically just trade the four major ETFs that follow the indexes. We trade the Dow Jones Industrial Average, which the ETF for that is DIA. We trade the ETF SPY, which follows the S&P. We trade the ETF IWM, which follows the Russell 2000, and then we also trade the ETF QQQ, which follows the NASDAQ. So we just focus on those four things and trend, and it makes it a lot easier to trade the markets, in my opinion. You're not chasing a bunch of different stocks. You're not having to look at earnings reports. You're not having to look at you don't have to worry about an earnings report coming out and it being bad, and then all of a sudden everything you just gained, you just lost. So even our method has its pros and cons, but I believe it has more pros than just trading individual stocks. So let's kind of get into it a little bit. I was reading earlier on Twitter where Game of Trades was talking about how the Dow Jones Industrial Average just recently printed a golden cross. So people may ask themselves, well, what the heck's a golden cross? So let's find out what a golden cross is when it comes to technical analysis. And bear with me on my some of my video stuff here, because I'm still learning how to use this thing. So you may get moved all over the screen. Let me see if I can find it here real quick, and bear with me 1 second. So a golden cross is, here we go, get myself off of here. A golden cross is a chart pattern in which a relatively short-term moving average crosses above a long-term moving average. The golden cross is a bullish breakout pattern formed from a crossover involving a security's short-term moving average, such as the 15-day moving average, breaking above its long-term moving average, such as the 50-day moving average, or resistance level. As long-term indicators carry more weight, the golden cross indicates a bull market on the horizon and is reinforced by high trading volumes. The key takeaways are: a golden cross is a technical chart pattern indicating the potential for a major rally. The golden cross appears on the chart when a stock's short-term moving average crosses above its long-term moving average. The golden cross can be contrasted with a death cross indicating a bearish price movement. So let's look at the Dow Jones Industrial Average, okay? And let's just see if we can see that golden cross. And this is a daily chart of the DIA, okay, Dow Jones Industrial Average. So if you look over here, we have the black line, which is the longer 200-day moving average. We have the green line, which is the 10-day moving average. We have the fuchsia line, which is the 20-day moving average, and we have the 50-day moving average, which is the 50-day moving average. So the 50, which is the red line, and the 200 are kind of like the main ones that most investors look at. So notice how the red line has crossed up, the 50-day moving average has crossed up over the 200-day moving average. That is considered a golden cross. Very bullish. Now notice how we had this big pullback over the last 3 days. Excuse me. I'm sorry. So we have a very bullish setup here in the Dow Jones Industrial Average. It's leading the markets. Now the other three indexes have not produced a golden cross yet. But typically, when you get one index like this producing a golden cross, usually you'll find that the other three indexes will eventually follow. So again, this is bullish price movement. This pullback here, doesn't mean we're getting bearish as long as we stay above these moving averages here. So I believe these prices are pulling back to actually slingshot higher. So the coming days will tell us whether or not that's going to be true or not. So let's kind of look at the SPY on the weekly chart, and we still have 1, 2, 3, 4, 5, 6. We have 6 green dots on the weekly time frame, and these are buy signals. So over the last 6 weeks, we have been bullish. The price percent oscillator has crossed over the blue line going positive, and that is still bullish. The derivative oscillator up here, we still have 6 green bars. Now the bars have gotten smaller over the last couple weeks, have gotten a little weaker, but that does not mean we are turning bearish. When we get one of these moves down here like this, then I would say, yeah, we're getting ready to get into a bear move. So that's the S&P. Let's go ahead and look at the Dow Jones, since we've been talking about the Dow Jones. And we have 1, 2, 3, 4, 5, 6, 7, 8 dots. 8 weeks we have been bullish on the Dow. Yes, we have pulled back. 1, 2, 3, 4, 5, 6, 7, 8 green bars on the derivative oscillator. The price percent oscillator is still moving positive. If we look at the IWM for the Russell 2000, same thing. We have 1, 2, 3, 4, 5, 6, 7, 8 green dots. So that has been positive price movement. 1, 2, 3, 4, 5, 6, 7, 8. 8 green bars on the derivative oscillator. Yes, the bars have gotten weaker. So one more. Let's look at the Qs. Qs have been the most lagging. Have been lagging the most out of all the 4 indexes. So we have 6 green bars, which have been buy signals, and we have 1, 2, 3, 4, 5 green bars on the derivative oscillator. Price percent oscillator is still in the positive, and still in positive movement. Now, over the last couple weeks, I will say it's been weaker, but it hasn't changed and hasn't become bearish. So, I remain bullish, especially with the price percent oscillator. Especially with the moving averages getting a golden cross here, the 50-day moving over the 200-day moving average. So, that just tells me that, the bears are not ready to throw in the towel yet. We are, when these certain type of technical indicators occur, it's usually very bullish. So everybody and their brother is bearish right now. And if you look at the economy, listen to the news, the sky is falling. That's herd mentality. So I have learned that looking at the charts, looking at technical analysis and so forth, gives us kind of a crystal ball view into what price movement may do in the future. and price does not always line up, or the markets do not always line up with what you hear on the news and what you hear from all the talking heads in terms of what the market may do. So that's why I have chosen to learn charting, learn trend, and follow the trends and follow technical analysis, because it leads over the news, over data, over the talking heads. And if you learn this stuff, you will be ahead of the game, in my opinion, because I have my portfolio results have basically been a lot better since I started trading this way. And if you listen to the news, you listen to the data, and you don't follow the trends in the charts, I believe your portfolio could suffer, because my portfolio did suffer for many, many, many years. Listening to the data, listening to the talking heads, and not learning how to read the charts, how to read the trends. So, again, this is my update for this week, and if anyone is interested in getting more information, again, we follow the markets on a daily basis in our Telegram channel, and we'd love to have you on board. Love to have you come out and try it out, and just give it a test drive. Test it out. See if we're not perfect. If we make a wrong move, I'll be the first one to admit it. But as of right now, I don't have any reason to be bearish. The trend and the charts with the golden cross and so forth on the Dow are all just kind of telling me that we're heading north. In the markets. So the other thing I want to show you guys real quick. Let me Google this real quick. Energy prices. Energy prices. I live near just north of Cincinnati, Ohio, and if I Google, I should have had this pulled up already, but if I Google gasoline prices in Mason, Ohio, gas prices have been over $3 a gallon, and it's energy prices have been very difficult on the economy, and I think when you have high gas prices, it also affects consumer confidence. So just over I don't know if you guys where you guys are at, but if where I'm at, let's see if I can get this off the screen here. Where I'm at, prices are starting to drop with under $3 a gallon. So look at all these prices near me, all of them. There's only one down here at the bottom that's over $3 now. So they're all under $2. As we get into lower energy prices, lower gas prices, and so forth, I believe we're going to see inflation come down. You're going to see some more confidence come back into the markets. Now, is this economy out of the woods with all the stuff that's been going on since COVID? No, there's still a lot of problems out there. But I do believe we are going to be bullish for a little while. How long? It's hard to say. We could be bullish between now and middle of summer, and then we could get bearish again. But things are starting to look at least temporarily bullish. I don't want to be bearish during a bull market. You're going to lose money. So, when things turn bearish and all the indicators are pointing down, I am going to get bearish. But right now, things are starting to point up. And, the markets move. The markets move in a they'll go straight up and they'll go straight down. They kind of move like a snake. They kind of pivot as they move. So, if we look at a monthly chart here on the Dow, it did not go straight up. It goes up, back, up, pulls back, up, pulls back. But overall, we're still in a very long, uptrend. This chart goes all the way back to 1996. Yeah, we had some pullbacks, but right here is where we just recently just had a pullback. But a snake moves, and if it's moving like let's just say it's moving up a hill. I mean, it's going to slither up and back, and just kind of pivot as it moves. And so when I look at the markets, I don't know, this is a weekly chart. It is kind of starting to pivot, and it pivoted right here, and it's starting to pivot again, and it looks like it's pivoting higher to me. So higher highs, higher lows. Again, this right here around December. What was it? October 13th. It was right here. October 13th is when we got this big bullish engulfing candle, and then we started moving up from there. Okay. Now, yes, the market did kind of start to kind of like level off and pull back, but again, until we start breaking down from the golden cross area, which I'll be very surprised if we do. I think we're going to slingshot higher. I think we're going to remain bullish. So that's all I got here, guys. It is December 17th at 3:36 p.m. And you guys have a good rest of your weekend, and we will talk to you soon.